Hi everyone, welcome to Module 1 Investor Psychology. This online course is brought to you by Journey with Money. Do visit us at our website at www.journeywithmoney.com as we have lots of useful content there to help you in your investing journey. My name is Marcus and I'll be your trainer for this course. Personally, I think this first module is very important. In order for you to be a successful investor, you must first of all have the right mindset. Mindset is something that is very hard to learn, and you must try to first take control of your emotions and make a conscious effort to follow a set of sound investing principles that will guide you to succeed in the stock market. I've met many successful investors, and most of the time, what separates them from the rest is their mindset. Of course, I'm not saying that investing methodologies and frameworks are not important. If not, we won't even be teaching you the rest of the other modules. But even with the right knowledge, you need to have the right mindset in order to succeed. This is why I say having the right mindset is so important. As an investor, we must first know the difference between investing in a stock and speculating in a stock. Speculators are people who only focus on the stock price movements, hoping to make a quick gain from the movement. When people buy a stock with no knowledge of the business and they are simply betting the price movement, it is like going to the casino to gamble. This can be risky as they may fall prey to price manipulators. This is a separate topic altogether, but you must understand that there are people out there who will try to manipulate the stock price movements through classic pump and dump strategies. And often, ignorant beginners in the stock markets usually will fall prey to their schemes. So it is important that you must have a right set of investing principles and a proven systematic way of picking the right stocks to buy. On the other hand, investors are people who buy a stock because they believe in the company. They want to invest based on solid business fundamentals, not because they speculate that a stock will always keep rising in price. Now, let's take the example of McDonald's, the fast food chain that we are so familiar with. They are in the business of selling hamburgers, fries, milkshakes, and Coke to customers. The more food they sell, the more money they make, and this in turn will make them more profitable. The business itself is listed on the stock exchange, and every day, depending on supply and demand, the share price will fluctuate. As investors, we are not concerned with the daily fluctuation in price, but we are only interested in the underlying business. So our focus is always on the business. This is not to say that the daily fluctuation doesn't concern us. In fact, the volatility in price will give an opportunity for us to buy the stock at the price we want. So investing is really that simple. You must think of yourself as a business owner. As investors, we just want to buy businesses and we buy them at sensible prices. It's really so simple. Keep things simple and sensible. But how do we define a good business? A good business is one with strong and wide economic moat. We'll be talking more about economic moats in Module 3. And we always want to buy a good business when it's at the right price, not when it's too expensive. In Module 5, we'll be teaching you how you can value a business to see if it's cheap or expensive. As an investor, you must have a long-term investment horizon. When you invest in a business, you need to give it time to prove that your investment thesis is correct. Benjamin Graham, the father of value investing, he is Warren Buffett's mentor, said this: in the short run, the market is a voting machine, but in the long run, it's a weighing machine. In essence, he's saying that in the short run, market is driven by people's emotion, but in the long run, what drives the stock price is its business fundamentals. If a business is profitable, its share price will eventually increase. And the next important thing you need to know, especially if you're a beginner, you must always stay within your circle of competence. Because you obviously make less mistakes when you invest in something you understand and are familiar with. Simply put, only invest in what you know and understand. By concentrating your effort on a few industries you are really good at, your risk is reduced and your odds of making money in your investments is increased. So you may ask me, Marcus, how do I know what's my circle of competence? Well, to put it another way, your circle of competence can be your circle of interest as well. Because I know some of you are very humble and you may be saying this to me, I'm not competent in anything, which is not true. I believe all of us have our own strengths and giftings. So I like to use the word competence and interest interchangeably. So you can say your circle of competence, your circle of interest. And a lot of times, your circle of competence is your academic background, the training that you went through. For most of us, it will be your educational background, what you specialize in. Like if you were to study finance, that will be your area of specialization. Some of us, we study engineering in college. You are an engineer by training, so your area will be in, it can be in electrical engineering, mechanical engineering, the manufacturing sector, whatever. And this makes sense because from a starting point, if you're totally clueless about investments, if you want to have an edge over others, and you choose to study the industry that you're in, and usually the industry that you're working in, for example, if you are working in the manufacturing sector, you will know the industry very well compared to other people. You will know the whole value chain. You will know who are the suppliers, who are the customers, who are the end consumers. You know everything at your fingertips. And this will help you to actually understand the business better. And when you are looking at companies in the particular sector, you have an edge. Of course, we do not just stay there. Sometimes your hobbies or things that you're interested in, you tend to read a lot. And these are the areas that you may be familiar with. So these are some of the areas that you can choose to do further research and study on, and this you can see where it leads you. Another thing to know is your own family and friends, your relatives. These are people that you interact with on a day-to-day basis, and you can always tap on their knowledge and their expertise. You shouldn't just stop at your own. No man is an island. That's why we interact with people, we network with people, because we are able to learn from one another. Let's say you have a few friends who work in the hospitality industries. You can actually ask them about how hotel works, how the industry itself make money, and whatever they share with you are actually insider informations. Insider in the sense that there are people who work in the industry, they know how the industry works. And as an investors, we want to grow, we want to increase in our knowledge. So as we become more and more seasoned, we will do not want to limit ourselves to just one or two industries, right? That's where reading comes in, interacting with people comes in. That's where you will actually grow yourself. And lastly, as long as you are an end consumer, you purchase or you buy a product or a service, then I will say that you are able to come up with investment ideas. Investment ideas are all around us. We just need to open our eyes. Well, if you were to step into a supermarket, look at the shelf, and as you are deciding, which brand of biscuits to buy. Well, sometimes you can just go further and do further research, further study, go online, do a good. You find that actually a lot of these brands, they are actually companies and they are listed, and you can actually buy into their business. So you see, there you have it. Investment ideas are all around you. It's whether you open your eyes, and whether you want to study and do further research on them. And I would say that as an investor, you need to be long term. You need to think long term, of course, but having patience is very important. Let's say you have a few great companies on your watch list, but the stock is way too overvalued. Or you are already invested in certain stocks, but the price hasn't moved one bit in the right direction upwards, and has in fact gone down quite a bit. Whichever situation it is, the only thing you can do is to wait patiently. I really love this quote from Warren Buffett. He says, no matter how great the talents or efforts, some things just takes time. You can't produce a baby in 1 month by getting 9 women pregnant. So well said. Without patience and conviction, and when stock prices take a plunge, it's easy to think you make a wrong decision and choose to let go of a potentially great investment. But as long as you're confident of your research and the long-term growth potential of investments, you must have the conviction to hold on in spite of all the noise around telling you otherwise. Ditching your investments prematurely because you don't see any results now will not yield you any results in the future either. Sometimes you might make money on an investment within a day, sometimes it might take just a few years. The key is to have an unwavering patience for the investment to prove itself. But a point in caution here, I just want you to take note of this, that this only applies if the long-term business fundamentals of a company are still intact. I'm not asking you to hold on to it and blindly. Sometimes there's no point in holding on a company that's headed downhill with no signs of recovery. So in the later modules, we'll teach you how to actually analyze a company and when is the right time to actually exit your investment or to sell your investments. And lastly, I would like you to know this concept of compound interest. Albert Einstein said it wonderfully. Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. If you want to get rich, you need to understand the power of compounding. And I really like this table that I have here on this slide. So let's say you have a base investment amount of 50,000, and we have come up with a different time frame, 5 years, 10 years, 15, all the way down to up to 35 years. And we have given you different rate of returns because all of us may have different rate. Let us be conservative, and I think this is being conservative. It's not hard to expect a rate of return of 5%. If you were to follow a proven systematic way, it's really not hard to come up with 5%. Let's say if you have a rate of return of 5%, and whatever money you earn each year, you put it back in and let it grow and invest in it further, you can see that by the end of 5 years, you actually get $63,814. If you go all the way to 20 years, you actually get $132,665. And all the way down to 35 years, with a rate of return of 5%, from a base of 50,000, you can grow your money to $275,800. And of course, we know that rate of return will not stay constant. In some years, you earn more, some years you earn less. But I think 5% is a good return to look at, right? But I think as a successful investor, you can look at a range of between 10 to 15% when it comes to your rate of return. So you see, compounding your money is so important. A lot of times, people, like, whatever they earn, they like to spend it. But if you were to just put it back and plow it back into your investment again, you can really grow your wealth very fast. What we are offering here is not some get rich scheme, but through a very disciplined way of investing, a very structured way, a systematic way of investing, picking the right stocks, and letting your money work for you. And I know that all of you here wants to achieve financial freedom. If not, you will not even be attending this online course, because you want to learn how to invest, how to grow your wealth. Now with this, I come to the end of module 1, and I hope you have learned what you need to know in this module. Feel free to always go back. I mean, that's the wonder of an online course. You can always replay it and go back to the video and relearn it and revise those key points. But this is really what we want to, set the record straight, because like I said, there's no point in learning, methodologies or a framework, but you do not have the right investor mindset. That's why this module is so important. So with that, I end this module. Thank you very much.